Let's talk about this market. On Friday, we get some earnings. We won't talk about your bank specifically, of course, for obvious reasons. What are you expecting this earnings season from the banks, from big tech, and can this rally broaden out?
John, so it's going to look better than it did in March. I think there were so many head fakes and noise at the end of the first quarter that even the Fed got faked out on, right? They expected us to be in recession by now. There were a lot of people saying that by July and September, the Fed could be easing. And as you said, right, this is a year where the narrative changes every single week, and that's true. John, we have dropped our recession probability from 40% in March to 25% now. We are pretty highly convicted that we're in the midst of a soft landing. So what does a soft landing look like? It means that the economy can continue to grow and avoid recession, and that's why we dropped our probability. The second piece is employment stays strong. And I think that's been the signal all along. Like, there have been people like, we're going to recession, we're going to recession. You need this labor market to crack. And that has been very, very resilient over time. And then the third piece is the easing has to get pushed out. And that, I think, was one of the biggest misses this year, was that there was so much easing priced into the back half of the year that had to go along with the crisis. You had to be long a crisis if you believed in an easing in the back half of this year. Now, the deflation trajectory flattens out. That's certainly the case, which is why the easy is being priced out. You heard Mary Daly last night, 2 more hikes. I think that's appropriate. They're probably going to do 1 more hike than they're comfortable with, because we're nowhere near our target of 2% core inflation. But it is an awesome time to be a multi-asset investor. We were up 10% in the first 6 months of this year in a balanced fund. Nobody's talking about that. Everybody's talking about NVIDIA. I think the balanced fund up 10% is really exciting as well, and certainly more than that 3-month T-bill that's at 5%. That's been my nemesis all year, and there's way too many people.
I love your research on the concision of it at the end. You say, do this, do this, do this. But the Phil Camporeale idea here is you got to be in the market.
Yes.
I want you to talk right now to people who are scared stiff. What's the level of fear out in the street? Because don't you have to go up with a wall of worry?
Yeah, so, and we've heard it all year. We've heard debt ceiling, we've heard regional bank crisis. It was a foregone conclusion that there was going to be a recession this year, Tom. And I'm not talking people to get out of cash and go into equities. That's not what I'm saying. I'm saying when you're making a bet on a balanced, diversified portfolio, which, by the way, has worked over so many years, you're not making a bet on stocks or bonds. You're making a bet on the relationship between those two asset classes, which was absolutely inverted last year. Last year was the first year since 1974 that both stocks and bonds went down in the same year. And I came on this show and told you, you know what, we have the best forecasted return for the 60-40 that we've had since 2010 coming into this year. So, Tom, those are the folks that I'm after. They're sitting there in the 3-month T-bill. It's like the best hedge fund out there, right, at 5+%. And they're saying, I'm safe here. Well, you know what? If the balance fund's up 10% in 6 months, their opportunity cost just went up.